Investing is all about growing your wealth, but one bad decision can set you back years. The mistakes I'm about to share aren't just theory, these are real lessons from people who have lost their hard earned money because of them. This advice comes from practical experience, and by avoiding these pitfalls, you can protect your wealth and invest smarter. Make sure to watch till the end because mistake number 5 is the fastest way to lose money. Mistake number 1: keeping money in cooperative banks. If you think your money is safe just because it's in a bank, think again. Many people have learned the hard way that cooperative banks are far riskier than commercial banks. The PMC bank crisis in 2019 is a prime example. Thousands of depositors were left stranded when the bank collapsed due to fraud and mismanagement. People had their life savings stuck for years with no access to their funds when they needed them the most. The problem with cooperative banks is that they often suffer from poor governance and political interference. Unlike major commercial banks, they don't follow the same strict regulations, making them vulnerable to financial mismanagement. To make things worse, RBI's deposit insurance only covers up to 5 lakh rupees per account. Anything beyond that is at risk in case the bank fails. That's why, if you have a significant amount of money in a cooperative bank, you might want to rethink your strategy. A much safer approach is to keep your funds in well-regulated commercial banks like SBI, HDFC, or ICICI. And if you're looking for better returns on idle cash, consider liquid mutual funds, which offer better safety and liquidity. Mistake number 2: not investing in direct plans of mutual funds. Many investors unknowingly invest in regular plans of mutual funds without realizing that they are paying unnecessary commissions year after year. Regular plans charge a higher expense ratio because they include distributor fees, and over time, these small percentages can take away a big chunk of your returns. For example, let's say you invest 10 lakh rupees in a mutual fund. A regular plan with a 2% expense ratio will eat away more of your returns compared to a direct plan with a 1% expense ratio. Over 20 years, assuming a 12% return, the direct plan would grow to around 96.5 lakh rupees, while the regular plan would only reach about 81.6 lakh rupees. There's a 15 lakh difference just in hidden costs. The smartest way to invest is through direct plans, which are available on platforms like MF Utility, Coin by Zerodha, or Kuvera. It's a simple change, but it can save you lakhs over the long term. Mistake number 3: thinking that ULIPs are a good investment. Unit linked insurance plans, or ULIPs, are aggressively marketed as the perfect mix of insurance and investment. But in reality, they are neither a good insurance policy nor a good investment option. Many people fall for the sales pitch only to realize later that their money is stuck in an underperforming investment. ULIPs have multiple charges hidden within their structure: premium allocation fees, policy administration charges, fund management fees, and more. These charges can eat away as much as 4 to 6% of your money every year. On top of that, ULIPs come with a mandatory lock-in period of 5 years, meaning you can't exit early without penalties. Even after the lock-in period, the returns from ULIPs often struggle to match those of simple equity mutual funds because of the high costs. If you've ever met someone who invested in a ULIP, chances are that they regret it. A much better approach is to keep insurance and investment separate. Buy a pure term insurance plan for protection and invest in equity mutual funds for wealth creation. Insurance is meant for safety and investing is meant for returns. Mixing the two only leads to mediocre outcomes. And that brings us to mistake number 4, which is mixing insurance and investment. A common mistake many people make is purchasing endowment plans, money-back policies, or traditional life insurance policies thinking that they are good investment options. In reality, these products offer terrible returns and poor financial flexibility. Traditional life insurance policies typically provide annual returns of just 3 to 5%, which barely beats inflation. Not only that, they also fail to provide adequate life coverage. For example, someone might buy an endowment policy with a 10 to 20 lakh cover, thinking their family might be financially secure, but in reality, if something were to happen to them, this amount would be nowhere near enough for long-term financial protection. Another major drawback of these policies is their lack of liquidity. Once you invest, your money is locked in for 10 to 20 years, and withdrawing early comes with heavy penalties. Compare this to investing in mutual funds, stocks, or ETFs, where you can access your money whenever you need it. For example, if you put 10,000 per month into a money-back policy, after 20 years you might receive around 30-35 lakhs, but you invest in the same amount in a mutual fund SIP at 12% returns, you could have about 1 crore. The best approach is to buy a simple term insurance plan with high coverage at a low cost and invest separately in a market-linked instrument like mutual fund or ETF. This way, you get both proper financial protection and the potential for real wealth creation. Mistake number 5: gambling in futures and options, or FNO. If 90% of traders lose money in FNO, do you really think you'll be in the 10% that makes profit? The stock market is a great place to build wealth, but when it comes to derivative tradings, the odds are stacked against retail investors. SEBI's study found that between FY22 and FY24, over 93% of retail traders in the F&O segment lost money. The average loss, 2 lakh rupees per person. The problem is that F&O trading is highly leveraged, meaning a small movement against you can completely wipe out your capital. Many traders enter the market thinking they can make quick profits, but they don't realize that options lose value over time due to time decay, and leverage magnifies even small losses. For example, a retail trader with 50,000 in capital can take an F&O position worth 5 lakh rupees using leverage. If the stock moves just 5% against them, they lose their entire 50,000. That's why so many people enter the market with dreams of making it big, only to leave it with nothing. If you truly want to build wealth, focus on long-term investing. Stocks, ETFs, and mutual funds provide solid returns over time without the extreme risk of F&O trading. F&O isn't investing, it's gambling. And in the long run, the house always wins. By avoiding these 5 common investing mistakes, you can protect your hard-earned money and set yourself up for real financial growth. Avoid keeping large amounts in cooperative banks. Always invest in direct mutual fund plans. Steer clear of ULIPs. Don't mix insurance with investing, and stay away from high-risk F&O trading. These are mistakes that have cost people lakhs of rupees, but now you have the knowledge to avoid them. Tell me in the comments, have you made any of the mistakes before? And if you found this useful, don't forget to like, subscribe, and join my Telegram group for more insights on smart investing.